America had no bank deposit insurance until 1933. When banks failed, your savings just vanished. Think about this. For the first 144 years of American history, if you put your money in a bank and that bank failed, the money was simply gone. Not delayed. Not partially refunded. Gone. No government agency stood behind it. No insurance fund made you whole. No letter arrived telling you when you'd see a fraction of it again. A farmer in Nebraska could work 15 years, save $400, walk into town to find the bank's doors chained shut, and that was the end of it. His life savings converted into a worthless ledger entry inside a dead institution. Between 1921 and 1933, more than 15,000 American banks failed. This is the story of the century-long gap between the invention of the American bank and the invention of the promise that your money inside one would actually be safe. Origins. The problem starts at the founding because the United States never really decided in any settled way who should be allowed to run a bank or what should back the money inside one. Alexander Hamilton wanted a strong, centralized national bank, modeled loosely on the Bank of England, that could stabilize currency and finance the young federal government's debts. Thomas Jefferson and his allies distrusted concentrated financial power almost as much as they distrusted the British Crown, and saw a national bank as a tool for entrenched elites at the expense of ordinary farmers and tradesmen. That argument didn't get resolved. It got postponed, fought over, revived, and postponed again for the next 100 years, swinging back and forth with whichever political faction held power. The First Bank of the United States lost its charter in 1811 when Congress declined to renew it. A second attempt, the Second Bank of the United States, was killed off deliberately by President Andrew Jackson in the 1830s, in a political fight he treated almost as a personal crusade. Jackson vetoed its rec charter in 1832 and ordered federal deposits pulled out of it in 1833, leaving the country once again without any central institution responsible for the stability of the banking system as a whole. What filled the vacuum was not stability. It was chaos by design. From 1836 to 1863, a period historians call the free banking era, states could charter banks with minimal federal oversight. In many states, literally anyone with a little capital and some government bonds to post as collateral could open a bank and start printing his own paper currency. There was no FDIC. There was no Federal Reserve. There wasn't even a uniform national currency. By the 1860s, an estimated 8,000 different kinds of banknotes were circulating in the country, issued by thousands of different banks, each one only as trustworthy as the institution that printed it. Some of these banks were legitimate community institutions. A great many were not. They became known as wildcat banks, a name that, according to banking folklore, came from banks so deliberately hard to find that a note holder trying to redeem his currency for real money would supposedly have to travel out to where the wildcats lived, deep in the countryside, to locate the bank's office at all. That's not a legend about honest business practice. That's a description of a scam. A bank would issue notes, back them with bonds of questionable value, and count on the fact that most people would never actually show up to cash them in. When people did show up, the bank was often already gone. The Civil War forced some order onto this mess. The National Banking Acts of 1863 and 1864 created federally chartered national banks, a uniform national currency, and a comptroller of the currency to regulate it. That solved the counterfeit currency chaos. It did almost nothing to solve the deeper problem, that when a bank failed, whether wildcat or perfectly legitimate, depositors were still on their own. Now, what does this mean in practice for an ordinary person living through it? It means your entire relationship with your own money depended on the character and competence of one local businessman. The banker, with no institution standing behind him if he guessed wrong, gambled recklessly, or simply closed his doors one morning and didn't reopen them. Banking panics kept coming anyway, 1873, 1893, and then, most consequentially for what came next, 1907. Each of those 19th century panics followed a similar pattern. Some shock, a railroad collapse, a stock market scare, a failed speculative scheme, would spook depositors in one city. Word would spread. People who had never given their local bank a second thought would suddenly remember that nothing legally guaranteed their money was actually there, and they would rush to pull it out before their neighbors did. That rush on its own could kill a perfectly solvent bank because no bank, then or now, keeps enough cash on hand to pay out every depositor at once. The money is out in loans, mortgages, and investments, doing the economic work banks exist to do. A bank run wasn't just a symptom of failure. It was often the actual cause of it. Escalation. The Panic of 1907 is the moment the country first seriously entertained the idea that depositors needed a government-backed safety net, not just a more orderly currency. The panic began with a failed attempt to corner the copper market, spread into a run on New York trust companies, and ended only because the financier J.P. Morgan personally organized a private bailout, gathering bankers into his library and essentially locking the door until they agreed to commit the funds needed to stop the bleeding. Total lending by trust companies fell by more than a third in just a few months. Real economic output dropped by double digits. And the uncomfortable lesson the country took away was this: the stability of the entire American banking system had just depended on the goodwill and liquidity of one private citizen. Oklahoma, which became a state that same year, reacted by writing bank deposit protection directly into its founding law. In 1908, it became the first state in the nation with a compulsory deposit guarantee system, funded by a 1% tax levied on the banks themselves. For a while, it worked, and Oklahomans took real pride in the boast that no depositor in the state had ever lost a penny. But cracks appeared almost immediately. The very first payout under the system came in 1908, and critics quickly accused regulators of shutting down fundamentally healthy banks for political reasons just to test the fund. Then, in 1909, Oklahoma City's Columbia Bank and Trust Company, a fast-growing institution that had aggressively advertised its guaranteed deposits to attract customers, collapsed, owing roughly $2.5 to $3 million to depositors. It turned out its officers had been investing that guaranteed money with little regard for whether it would ever be recoverable. That's the fundamental flaw of any guarantee system built without real oversight attached to it. Tell a banker his depositors are protected no matter what he does with their money, and you've just removed the one thing that used to make him careful. The system was funded entirely by the banks it covered, which meant it had no outside backstop, and by the early 1920s, a wave of agricultural bank failures overwhelmed the fund faster than the surviving banks could refill it. Between 1908 and 1917, 7 more states, Texas, Kansas, Nebraska, Mississippi, South Dakota, North Dakota, and Washington, adopted similar guarantee funds of their own. All of them eventually collapsed, were repealed, or were quietly drained dry by exactly the kind of over-leveraged farm lending boom and bust that battered the rural Midwest and South all through the 1920s. Texas repealed its law outright in 1927 under pressure from bankers who no longer wanted to pay into a fund propping up their weaker competitors. By the time the country needed deposit insurance most, the state-level experiments that might have proven the concept had already discredited it in the eyes of many bankers and lawmakers, including some of the very people who would soon be asked to build a federal version. Because here is what the 1920s actually looked like underneath the popular image of jazz and prosperity. Banks were failing constantly, and almost nobody in the cities noticed because almost none of it was happening to them. Small, rural, single-office unit banks, most of them in communities of 2,500 people or fewer, many capitalized with less than $25,000, failed at a staggering rate throughout the decade. On average, more than 600 banks failed every single year between 1921 and 1929, most of them in farm country crushed by falling crop prices after the wartime agricultural export boom collapsed. In some agricultural regions, roughly 1 in every 2 small banks that existed in 1921 was gone by the end of the decade. Investors and big city bankers largely shrugged. They believed these failures were healthy, that weak, badly run small banks were simply being weeded out, proof the system was working exactly as it should. That confidence was about to be tested somewhere. It couldn't be dismissed as a distant rural problem. Then came October 1929, and the weeding out stopped being confined to small-town banks. The stock market crash didn't cause the wave of bank failures by itself. The rural banking system had already been rotting for most of a decade, but it turned a chronic problem into an acute national emergency. Bank suspensions, which had run to roughly 600 a year through most of the 1920s, jumped to 1,350 in 1930 alone, then kept climbing. Between 1930 and 1933, more than 9,000 banks failed across the United States, close to a third of every bank that had existed at the start of the Depression. This time the failures reached large, urban, supposedly rock-solid institutions the kind ordinary middle-class families had trusted precisely because they seemed too big and too established to fail. Depositors nationwide lost more than $1 billion, something like $20 billion or more in today's money, representing roughly a fifth of all deposits held in the failed banks. Behind every one of those numbers is a specific individual catastrophe. A shopkeeper's till, a widow's burial fund, a family's mortgage payment, wiped out overnight because the institution holding it collapsed and there was nothing behind that institution but its own vault. And because there was no federal insurance and most of the old state guarantee funds were already dead, there was no mechanism anywhere to make any of those people whole again. The clearest, most cinematic version of what this looked like on the ground happened in Detroit in February 1933. By then, the city's biggest banking group, Union Guardian Trust, closely tied to the Ford family, with Edsel Ford as chairman of its board, was hemorrhaging money. In the roughly 2.5 years before February 1933, an estimated $250 million had already been pulled out of Detroit's largest bank alone, and by January, the city's banks were losing $2.5 to $3 million a week just trying to pay out panic depositors. Union Guardian went to Washington, hat in hand, for a rescue loan from the Reconstruction Finance Corporation. Federal auditors offered $37 million, on the condition that Henry Ford, the bank's largest depositor and creditor, agreed to subordinate part of what the bank owed him to make room for the new loan. Ford refused. Treasury officials flew to Michigan and spent hours in Ford's office trying to talk him into it. President Hoover himself telephoned Ford directly and spent nearly an hour on the line, hanging up convinced he'd changed the old man's mind. He hadn't. In the early hours of February 14, 1933, at 1:30 in the morning, Michigan's Governor William Comstock declared a statewide banking holiday, freezing 550 financial institutions and roughly $1.5 billion in depositor assets behind locked doors. All because two of the wealthiest men in America couldn't agree on who would eat the loss first. It would be more than a month before Detroit's banks reopened under a newly organized institution. Picture the scene inside the Union Guardian building in the days before the closure. Tellers counting out cash across the counter as fast as their hands could move, lines stretching out the door and down the sidewalk into the Michigan winter, men in overcoats clutching passbooks, watching the numbers on the chalkboard behind the counter tick downward. Behind closed doors, the Reconstruction Finance Corporation had actually offered a rescue, $37 million, on the condition that the automakers who were Guardian's biggest depositors put up an additional $13 million themselves to share the risk. General Motors and Chrysler reportedly agreed. Henry Ford did not. And when a corpse of a trust company was left to threaten the whole city around it, the state simply pulled the plug on all of it at once. Ford wouldn't get his money out either. The holiday froze his funds along with everyone else's. It would take until March 24, 1933, 36 days after that first 8-day holiday was declared, before a newly organized institution, backed by federal money and General Motors capital, finally reopened Detroit's banking system, this time with customers lined up not to withdraw their money, but to put it back in. Michigan's holiday triggered a chain reaction across the country. Other states, watching depositors elsewhere start pulling cash out in fear of being next, declared their own emergency banking holidays through late February and early March. A patchwork of state-by-state shutdowns spreading state to state like a fire jumping fire breaks. By the time Franklin Roosevelt was inaugurated on March 4, 1933, the entire national banking system was effectively on the verge of simultaneous collapse. Not because every bank was insolvent, but because nobody could tell which ones were, and the fear itself had become the danger. The fight. 3 days later, on March 9th, Congress passed the Emergency Banking Act in a single legislative session that reportedly moved so fast that some members voted on a bill they hadn't even seen printed yet. It gave Treasury officials the authority to examine every bank in the country and decide, one by one, which ones were sound enough to reopen. Then, on the night of March 12th, the eve of the reopening, Roosevelt sat in front of a radio microphone and delivered the first of what would become 30 fireside chats, speaking directly to ordinary Americans in plain language about what had happened and what came next. He told them, in effect, that it was now safer to keep their money in a reopened bank than hidden under a mattress. The next morning, banks in the 12 Federal Reserve cities reopened. Lines formed outside not to withdraw money in panic, but to put it back in. Roosevelt's advisor Raymond Moley later put it bluntly, Capitalism, he said, had been saved in 8 days. But stopping the bleeding wasn't the same as fixing the wound. That fell to two men who did not particularly like or trust each other's approach. Senator Carter Glass of Virginia and Representative Henry Stegall of Alabama. Glass, a former Treasury Secretary, had been trying to pass sweeping banking reform since January 1932, long before Roosevelt was even elected, aimed mainly at separating risky security speculation from ordinary commercial banking. Stegall, who chaired the House Banking and Currency Committee, represented rural Alabama and cared above all about protecting the small, local banks that had been dying by the thousands for over a decade. Here's the thing, Carter Glass hated the idea of federal deposit insurance. He had watched Oklahoma's and the other states' guarantee funds fail one after another through the 1920s, and he considered federal deposit insurance a subsidy for badly run small banks, paid for by the well-managed big ones. As chairman of the Senate Banking and Currency Committee, and a man Roosevelt had actually offered the job of Treasury Secretary, which Glass turned down, his opposition carried real weight. He wasn't alone. Big banks lobbied hard against it, worried they'd end up footing the bill for every reckless country banker's mistakes. Even Roosevelt's own administration was skeptical of the idea, and reportedly threatened a veto over the deposit insurance provision at one point during negotiations. But Stegall wouldn't budge. He had spent years watching rural Alabama banks fail one after another, and unlike Glass, he wasn't interested in punishing small banks for the sins of Wall Street speculators. He wanted them protected. On May 19, 1933, defending the plan on the House floor, Stegall argued that the public was still too frightened to put money back into banks, and banks were too frightened to lend it back out, that the fear itself, not just the failures, was strangling the economy, and that federal insurance was the only way to break that cycle of mutual distrust. He made deposit insurance the price of his support for the rest of Glass's broader reform package, the one separating commercial and investment banking that Glass had spent a year and a half trying to get through Congress. Glass, staring down the collapse of everything he'd worked for since January 1932, finally relented and told Roosevelt to accept it. Public sentiment made Stegall's position far easier to defend than it would have been a few years earlier. Through early 1933, a Senate committee investigation, led by Chief Counsel Ferdinand Pecora, had been dragging Wall Street executives before Congress and exposing, in humiliating public detail, how some of the era's biggest banks had misled investors, manipulated stock prices, and extended favorable insider loans to their own executives while ordinary customers lost everything. One newspaper editor captured the public mood that winter by writing that the only difference between a bank burglar and a bank president was that one of them worked at night. Roosevelt and congressional reformers rode that wave of public anger to push the broader bill through in record time. On June 16, 1933, barely 3 months into Roosevelt's first term, the president signed the Banking Act of 1933, better known today as Glass-Steagall, into law. It separated commercial banking from investment banking, forcing institutions to choose one function or the other. And buried inside it, the provision almost nobody involved in drafting it actually wanted at the start, was the creation of the Federal Deposit Insurance Corporation. Resolution. A temporary FDIC fund went into effect on January 1, 1934, insuring individual bank deposits up to $2,500. A modest sum, but for the first time in American history, a legally guaranteed one. The permanent fund followed that July, with the coverage limit immediately doubled to $5,000. The results were almost immediate and almost unbelievable by the standards of the previous decade. Where more than 4,000 banks had suspended operations in 1933 alone, the annual average number of bank failures during the rest of the 1930s dropped to roughly 50 a year. But here's the thing, the 1933 law left real gaps, and it's worth being honest about what it didn't fix, not just what it did. Deposit insurance only covered amounts up to the new ceiling. Anyone with more money in a single account than the limit was still exposed above that line, a problem that would resurface again and again in later decades as the cap failed to keep pace with people's actual savings. Coverage applied to commercial bank deposits. It did nothing for the millions of Americans whose money sat with building and loan associations, credit unions, or brokerage accounts, several of which wouldn't get comparable federal protection until years, or in some cases decades, later. Federal credit union share insurance, for instance, wasn't established until 1970. And participation for state-chartered banks that weren't part of the Federal Reserve System was, at first, optional rather than mandatory, meaning plenty of small local banks, ironically the exact institutions the whole system was originally built around protecting, could and did simply opt out in the early years, calculating that the premiums cost more than the risk was worth. There was also a deeper, quieter cost that Carter Glass had warned about all along, and that regulators are still arguing over today: moral hazard. Once depositors know their money is protected regardless of how their bank behaves, they lose almost all incentive to ask hard questions about that bank's lending practices, its leverage, or its management. The discipline that used to come from depositors voting with their feet, pulling their money out of a bank they didn't trust, mostly disappeared. That trade-off was, on balance, worth it. The alternative had just cost the country roughly a third of its entire banking system in 4 years. But it was a trade-off, not a clean fix, and the men who built the FDIC understood that even as they signed the bill into law. Modern through line. This isn't ancient history. It's within living memory of people's grandparents and great-grandparents. A plumber or a schoolteacher in 1932 who watched a lifetime of savings disappear behind a locked bank door wasn't a figure from some distant century. They were somebody's actual family. And the system born out of that trauma is still the one protecting your money today, just scaled up and stress-tested repeatedly along the way. The coverage limit has climbed steadily over the decades, from $2,500 in 1934 to $5,000 later that same year, then upward again through the 1950s, 60s, 80s, and 2000s, reaching $100,000 in 1980, right before the savings and loan crisis, a period that saw hundreds of thrift institutions fail and cost taxpayers well over $100 billion to clean up. The limit was temporarily raised again in October 2008 in the middle of the global financial crisis, and Congress made the increase to its current $250,000 per depositor per bank permanent in 2010, almost exactly the same instinct that drove Stegall in 1933. Calm the fear before the fear does more damage than the failures themselves. It was tested again in March 2023, when Silicon Valley Bank collapsed with more than $200 billion in assets, the second largest bank failure since the FDIC started keeping records in 1934, and regulators made an emergency decision to cover deposits above the insured limit anyway, worried that letting large uninsured depositors take a loss would trigger the exact kind of contagious, multi-bank panic the FDIC was created to prevent in the first place. Which raises a question the original architects of deposit insurance argued about from the very beginning, and that nobody has ever fully settled. How do you protect ordinary depositors from catastrophe without also protecting reckless institutions and their largest and wealthiest customers from the consequences of their own risk-taking? Carter Glass worried about that question in 1933. Regulators were still wrestling with it 90 years later, live on national television. It's worth asking what the right balance actually is, and whether we've found it yet or just found a bigger, more expensive version of the same argument. Closing. If this story changed the way you think about that little FDIC sticker on your bank's front window, hit subscribe or drop a like. We go deep on hidden systems, money, and power, the stories most people never think about until the day they suddenly need to. I'll see you in the next one.